Hey everyone, me Kevin here. Multiple updates. We're going to do a very quick and brief update regarding the Fed minutes, what to expect, but more importantly, we're going to talk about what I've learned from some earnings reports, and I think they're quite fascinating. So first, Fed minutes. Could be totally nothing, could be a nothing burger. The last few minutes, I'd say like the last 2 minutes that we've gotten, absolutely nothing. The minutes that we got from December on January 5th, complete disaster, really started tanking the market even more in January. So yeah, you could end up having a very bad or very bad day after, and I would expect low volumes to start the day and then things to, trading to actually take place after these minutes come out, and for people to relax a little bit, hopefully, because what are we looking for? Well, we're looking for a Fed that's going to tell us, all right, look, we're already seeing demand start to moderate. That's what they want to do. They want to see demand moderate, and we're hoping that they give us some kind of guidance on what their terminal target will be for that Fed funds rate. The market is pricing in 2.75 to 3, and we talked about this yesterday, that Bostic started talking 2.5, and the market's like, oh crap, you guys are going to pause earlier than expected. Goldman Sachs put out a note going, that's basically what the market needs right now in order to really have a chance of actually going up, is basically a softer Fed, right? And so we're going to be looking at core. What is the Fed's expectation on core inflation? Are they seeing any meaningful signs yet? So far, they've been saying, yeah, we're seeing some signs, but not consistent enough yet. So we'll see if the minutes give us any color. I do want to talk about some of these earnings. So Ryanair, I thought this was really interesting. They're the low-cost carrier in Europe, which is actually where I am right now. I'm in Germany. And they say that, quote, it seems evident we are going to have an economic downturn, if not a recession. They say the recovery is fragile and that people will ultimately end up moving into more price-sensitive companies when they spend money. So kind of like they made this analogy of shopping at IKEA or flying on Ryanair, cheaper discounted airlines. This makes sense, but I do think it was very interesting that they said it seems evident that we're going to have an economic downturn. That could be because of Europe, which we expect Europe's going to have a harder time than America. Toast, on the other hand, and I thought this was really interesting, Toast says that dining in at restaurants is up 46% in Q1 compared to Q1 of 2021. And they see that demand is high, restaurants still have pricing power, and they, quote, don't see any evidence of a slowdown or material risk on that front yet. So, well, that's a good sign. Lowe's talked about how when home values are going up, people see spending on their home for home improvement or remodeling as a, quote, investment, not an expense. But this was also very interesting for the housing market. They believe that excess demand is somewhere between 1.5 to 2 million homes. That represents about 21 to 28% of the amount of homes that we sell. They believe that's how much excess demand there is for extra homes right now. And what's really interesting about that is it kind of gives us a little bit of guide. Well, if interest rates, have gone up 3%, and that saps about 30% purchasing power, is it possible that real estate could just end the year flat? It's possible. But Lowe's could also be wrong, and other people could also panic sell. Like if investors start panic selling, well then not only have you now absorbed the excess demand, but now you potentially end up having over inventory in real estate, right? So obviously, with the home builder or the home numbers miss that we had yesterday, you started seeing home builder stocks fall, and that's not a surprise. Lowe's did notice a slowdown in sales in April, but they blamed weather as an excuse for that. John Deere sees no improvement in freight, which is important for inflation, until next year, although kind of I'm wondering if they're not seeing an improvement because they're John Deere and they ship massive things. So I think that's kind of interesting. There's also an interesting report. This doesn't matter so terribly much, but it's just kind of funny that California has the world's 2 worst ports, Long Beach and the port of Los Angeles. And it's like no surprise to me that California taxes people in their state the most, yet they have horrible infrastructure and can't get their act together. It's quite sad. Xpeng Motors, they said they had a massive slowdown in April, much like Tesla, obviously, because of the lockdowns. But they are already seeing a robust rebound, and that momentum is strong already for May and getting those orders coming back. So that's potentially something nice to hear for Tesla, although they do still complain about the chip shortage. And what's fascinating about the chip shortage is they gave a little bit of color. They're like, look, we have like 5,000 chips in every single car. And it's not the big chips that matter. It's all of the tiny little cheap ones that are like pennies for a chip. Those are the ones that we're struggling getting. And I thought that was really interesting because I got to thinking to myself, like, yeah, I mean, they're probably like 5 chips just for me to push a button and like roll the window down, per window. And then, obviously multiply that by all the functions of a vehicle. Anyway, Best Buy talked about how the consumer electronics industry is in decline, but not to worry because we've been planning for it. And they don't see a full-blown recession, but they definitely see a decline. Obviously, we saw the Snap disaster, and the line that really ended up killing Trade Desk was them going, we believe platforms more exposed to brand advertising are likely experiencing a greater impact overall. So that really hurt. Canadians are really unhappy. According to a poll, 41% of Canadians have worse finances today than a year ago. And 28% of Canadians believe their finances will continue to get worse. That's not good. Job market, starting to see some layoffs take up. This is kind of expected when we expect demand to pull down. And the Schwab CEO, he bought the dip on his own stock. The stock's down 11%. Then one thing that I did want to end on, obviously, in addition to suggesting you should check out the amazing programs on Building Your Wealth down below, because obviously you should. Remember that coupon expires at the end of the month, but get this. Many stocks with the highest dividend yields in the S&P 500 have been soaring past the broader market. Broader market's down like 20%. AT&T, though, up 12% this year. And it seems like the S&P 500 high dividend index is up 2.8% so far in 2022. Anyway, I gotta go now. See ya.